Hello, and welcome to another session of Wellesley to Wall Street. In this video, we will be talking about financial ratios and how to use these ratios to measure a company's performance. So, let's say you want to understand how Company A is performing relative to other companies in the same industry. How would you go about this? So you could just look at their raw numbers. For example, let's say that Company A took in 700 million in profits last year, whereas Company B, their competitor, took in 200 million in profits last year. Okay. But this doesn't actually give you a great idea of how the companies are performing relative to each other, because maybe Company A is actually earning 10 billion in revenue, while Company B is earning 500 million in revenue. So this paints a more complete picture, knowing this information. We can now calculate what's called a profit margin. So a profit margin is expressed as a percentage and measures how much out of every dollar of sales or revenue a company actually keeps in earnings. So if we divide 700 by 10 billion, 700 million by 10 billion, we get 7%. But if we divide 200 million by 500 million, we get 40%. So now we can say that Company B is much better at keeping its sales as earning than Company A. So we like Company B. And this sort of just goes to show how important it is to take ratios so that you can compare things in the same way. Another way to think about these numbers is for Company A, for every dollar of revenue or sales they bring in, they only keep 7 cents as profit. And then if you look at Company B, it's for every dollar of revenue or sales they bring in, Company B keeps 40 cents as profit. So our last example, the profit margin, had the word margin. And a lot of ratios are going to have the word margin. And basically, that word should be a clue that in the denominator, you're going to have a net sales or revenue. So anytime you see the word margin, know that you have sort of something in the numerator and then you're dividing by net sales or revenue. So an operating margin divides, you guessed it, the operating income by net sales. It's expressed as a percentage, and what it looks at is how efficiently a company runs its core business. And here you can think of operating income as the profit that a company has after it takes out all of the expenses that it incurred for operating. So this could be something like wages that you pay out. Both operating margin and profit margin fall into the category of profitability ratios. And a profitability ratio, or an efficiency ratio as it's also known, attempts to measure a business's ability to generate earnings when compared to its costs. So in general, a company will want its profitability ratios to be higher than those of its competitors. Two other important profitability ratios to think about are return on assets, also known as ROA. The ROA measures how well a company is able to take its assets and turn them into profits. And then return on equity, ROE. The ROE measures how much profit a company can generate with shareholders' investments or shareholders' equity. Shareholders also care a lot about earnings per share and a PE ratio, which is a price to earnings ratio. These two ratios give information about how a company's stock is valued in the market. So if Company A has a really high PE ratio relative to Company B, then Company A could be overvalued. In other words, Company A's earnings just don't justify its high price. So financiers also care about a company's growth, especially if it's a new company. Thinking about a company's growth gives information about how much market share a company can capture in the future. So to measure growth, you can calculate a percentage change in revenue, profit, costs, etc. year to year. You can also look at the average growth rate over multiple years, and this is called a CAGR. And CAGR stands for a compound annual growth rate. So debt ratios are incredibly important because they provide important information about how leveraged a company is. The way you should think about leverage is that it's how much a company can increase how much it invests in its business ventures without increasing the amount of equity that people have put in. So imagine that you and I started a company and we both put in $5, you and me. And so, we have $10 of shareholders' equity in this company. Now, let's say that we wanted to do something with our company that cost $25. Ooh. Like, we don't have the money. But if we issue debt or an IOU, we could get $15 and then do whatever we wanted to do. But now our company is levered. So the higher the leverage, the riskier the company. But debt is also an important tool to help companies grow. Like in our example, taking on that $15 of debt helped me do whatever I wanted to do with our business. So common debt ratios include total liabilities to total assets, if you remember your accounting, you know that you should be able to find this on the balance sheet. Assets, as well as debt to equity and debt to total assets. Liquidity ratios are another type of ratio, and they are important to determine a company's ability to pay off its short-term debt obligations. So when you and I took that $15, we borrowed it from someone, we were making a promise to pay it back with interest. But if we don't have enough cash on hand to pay back its debt, so maybe we invested in a project with that $15 that didn't make us any money, then we could go bankrupt because when people ask for that $15 back, it's gone. So common liquidity ratios that sort of try to express how this can happen to a company include the current ratio and something called the quick ratio. To wrap up, I think it's important that we note that based on the industry in which a company operates, the ratios you use might differ. A young tech startup, symbolized by this light bulb, would want to use different ratios than a well-established corporation like GE because they're in different stages of development and they also do completely different things. For example, this cool tech company might use a metric involving website clicks, but that measurement wouldn't make sense for GE. Additionally, something like a bank or a fashion company, maybe a fashion company that's going into e-commerce, would have also different ratios which paint a picture of how they're doing.